All right, everyone. So this is the macroeconomics of 23 and 24. There are a lot of slides, so I may move quickly, but of course, there's going to be the recording that you can go back to. So let's start. Let's start with the cursor. All right, so 2023, the best way I can think of describing it is that it rattled markets and it confounded economists. So a lot of what economists were expecting, i.e. a recession, has not happened and most likely will not happen in the time frame that they initially envisioned. And it rattled markets because of interest rates going up in order to fight inflation that was supposed to be transitory and wasn't. And so the speed at which the Federal Reserve increased those interest rates rattled markets in a really big way and has had a really big impact on markets and investments. All right, so macro trends, and we're going to get into these. So we had persistent inflation, rising interest rates, unaffordable housing, recession fears, but then we had strong jobs, strong consumers, a strong economy, and at the same time, rising consumer debt. So these are some of the big trends that we saw in 2023. So going all the way back, 2022, inflation surged to a 40-year high. So it hit 9.1% in June of 2022. And it's come down. It's been coming down. And that's part of what the Federal Reserve was doing in its mandate to control prices, and raising interest rates was a way to do that. Where we're at today, because we can see back here that it has been coming down, and this is the trend that the Fed wanted. It has stabilized, but it's still above the 2% target that the Fed is looking for. The Fed is looking for 2% annualized inflation. We're sitting at about 4%. And it's been persistently strong, but not everywhere. It's been really strong in the services sector, but the price of goods in 2023 has started to fall. So car prices have fallen, furniture, electronics, those finally came down. And that was partly due to the supply chain issues easing. And because what happened in the pandemic, it just put a stop to this global supply chain. So prices went up. Housing costs, wages continuing to go up, especially in the services sector, and job growth, again, in that services sector, have been the critical factors in that higher core inflation. So that is what the Fed is really looking at, this measure of core inflation. And last month in November, the CPI came in at 3.1%. All right, so interest rates are the big thing. Like, this is the big thing that's been impacting everybody in ways that if you're a business owner or an investor, you've clearly seen. And if you're not, you're still being affected by it. So going back, the response to the pandemic in 2020, the Fed drastically cut rates to basically 0%. So it was free to borrow money. So what that did, though, is that free money, not only free in terms of its interest rate, but also in terms of they printed a bunch more money, threw an extra 40% of all money into the system. And that money had to go somewhere. And so that created massive bubbles. That also created inflation because you had so much more money chasing a limited supply of everything. So then we get into historic rate increases from 2022 to 2023. So when in late 21, the Federal Reserve famously said inflation is transitory, you can say, relatively speaking, it was and it is. But at that time, they actually really misread what was going on. And so inflation just shot up. And so the Fed was behind the 8 ball, so to speak. And that's what they did. They had to raise interest rates really quickly. And so then what they did is they raised them from basically 0 to 5%. When you do that to markets, it creates a massive shock. And we haven't seen anything like that since the 1980s. So I was a kid in the 80s. I certainly wasn't paying attention, so I don't know how that went. And now we have this current scenario in late 2023 where the Fed has paused. They're seeing inflation come down, and it's starting to come down to where they want to see it. So what they've done is, after raising rates really quickly, they're saying, okay, now we can pause. And this is really important for stability. So that Fed raise increase was the fastest in more than 4 decades. But they've held it steady now for 3 consecutive meetings. So what we're seeing is a little more stability. The markets are liking this. People are liking this. And the Fed is signaling, hey, we're going to move a little more cautiously. And it looks like they're set to achieve this infamous soft landing that the Fed said they were going to do, but economists didn't believe. So this is another way to look at the federal funds target rate. So you can see here in 2020, it just dropped to 0. And so we had 0% interest rates. And then you see it go all the way up that quickly. So that really rattles markets. That sends shockwaves. Because essentially, higher interest rates cause borrowing costs to increase. Everything. Mortgages, personal loans, credit cards, business loans, margin, like if you're trading on margin, like everything goes up. So like auto loans, just everything, government and banks also are affected by higher interest rates. So when we talk about what's affected, the number one thing that most of us pay attention to, have noticed, is housing. So we already were seeing the price of homes go up because so many people wanted to buy homes. And now when you have higher interest rates on mortgages, what was already really not that affordable is even more unaffordable because your cost of interest is just so much higher. You just most people can't afford it. And so we've had a stalling housing market. And then and auto is also a huge piece of the American economy. So people shopping for cars and financing cars. So if you change cars often and you rely on financing, it's going to be a lot more expensive to finance a car, buy a new car, not to mention that insurance on vehicles is up 30% this year after apparently insurers were not allowed to raise prices during the pandemic. So I saw in my own insurance, it was up 30%. I asked my insurance broker, I said, what is going on? And he said, yeah, this is across the board. It's not just, whatever my car insurance company was. So the other thing is credit cards are more expensive. And if you're able to, we've talked about this a lot, like if you can pay your credit cards off every month, that is preferable. Because if you're carrying a balance now, you're carrying a balance that's much, much higher than it was previously. So there's a couple stats here. You can see the American household before would need to use 42 weeks of income to buy a new car. And that's up from 33 weeks just a year ago. So you just have all of these massive issues with interest rates going up. Things become unaffordable because we rely on credit. The whole world relies on credit. There's more credit than actual money. So when you rely on credit and it costs more, and this is the point, this is what the Fed wanted. They wanted spending to come down. Business spending, personal spending, they wanted it to come down because they needed prices to come down. So they wanted to reduce demand by making money more expensive. So housing affordability. So we're back to a moment in time where it is cheaper to rent than it is to own because of the cost of mortgage. And that's outside of the cost of house insurance and maintenance and all that good stuff. So this is where the Fed policies have hit the hardest, and it's also where they lag. So you don't see the effect on housing or real estate for 12 to 18 months after. So this could also be why the Fed has decided to pause, because they're saying, hey, we have not fully seen the impact yet of our rate increases. And so they don't want to get into a recession so quickly. And so they're pausing. So we talked about this. High rates can add hundreds of dollars to monthly mortgage payments. And, again, American households need 44% of its income to cover annual payments on a home. That is the highest level of data, the highest level ever going back to 2006. So this has been a big thing. We have not seen a housing crash or a property price crash. Some people were calling for that. Again, economists were expecting that, but it didn't happen because a lot of people locked in really low rates during the pandemic and they're not moving. So they're not selling because where are they going to go? What are they going to afford? So this is what freezes it up, but it doesn't mean it's crashing because it's not crashing. All right, consumer debt. This is one I really look at because it's very telling of what may happen in the future. And it's also telling of what's happening today for a lot of people. So we have 10-year high credit card balances. We have annual percentage rates on credit cards on average more than 20%. That's a lot of money, 20% on your credit cards. And since most credit cards have a variable rate, when the Fed increases their rates, your credit card rate goes up. Or if you have a variable rate line of credit, like a home equity line of credit, usually those are variable rate. So we're seeing very, very high credit card usage. And, with the cost of living going up the way it has, that's not surprising. Even though there's been really strong wage growth, but it's not surprising. I mean, I see my grocery bills, I see all my other bills, and as frugal as I want to be, everything costs more. So this is hitting everybody really hard. But if you're relying on the debt part, and if you're not paying off your credit cards, this could really add up. So we're seeing this across the board. So where else did high interest rates have an impact? In banks. So there was a mini bank collapse in 2023. And I say mini because what could have been a contagion was stopped. And so with the high interest rates, I'm not going to get into the whole mechanic of how it happened, but essentially banks put their cash to work, and they put their cash in government treasuries that had really low interest rates. And then when a bank run was sparked and people started asking for their money, the banks had to sell those government treasuries, but they were worth less than what they bought them because interest rates were worth more. And so they were selling at a loss. And then all of a sudden bank balance sheets were negative, and it just turned into this great big thing. So interest rates also affected banks, something to watch out for in 2024, because the Fed put in a mechanism to allow, especially small regional banks. The big banks were fine. Actually, all the money from a lot of small regional banks went into the big banks. So these smaller regional banks, which are the backbone and the centerpiece of small business and lending and real estate, these are the ones that are at greater risk, which is crazy if you think that like the banks are at risk, but it's also which kind of banks. So this is a really big thing. I mean, small banks are responsible for 70% of all small business lending. And if these banks go out of business, that's a massive problem for the economy because so much of the economy is driven by small businesses. All right, so those are, when we talk about what's affected by high interest rates, a lot, like so very, very much. So these are some of the things in 2023 that were affected. So what about that recession? What about that recession that all the economists were saying, there's going to be a recession, there's going to be a recession? There was not. There was economic growth. So the economy has outperformed forecasts from a year ago. And financial news outlets were reporting a year ago that a recession was imminent, but it really has not happened. And this is what I meant about it confounded economists. Real GDP has grown at 2.9%. So it's growing, and we're going to get into why it keeps growing. But this is one of the key things in 2023 that was supposed to happen. And you saw all the headlines about recession, but a lot of the underlying data the whole time was saying that there was not a recession coming. So forecasts and economists and even markets, financial markets, are forward-looking mechanisms. So they're basically trying to foretell what is happening based on data today, what's going to happen in the future, but nobody really knows. This is a great example of this. So consumer spending, why is the economy still strong? Two-thirds of American economy of GDP is based on consumer spending. So if the consumer is spending, the economy is strong. This is a really good way to put it, because consumption makes up two-thirds of the U.S. economy on average. So as the U.S. consumer goes, so goes the U.S. economy. And so the biggest surprise in the economy's performance from about a year ago is that consumer spending piece. And part of that, and we'll get to it here in a minute, is that we still had rising wage growth, and that fueled spending. And this is also inflation adjusted spending, because you could say, yeah, but Adpia, inflation. So of course, there was more money. No, it's we're talking about inflation adjusted. So as this is a headline from the Wall Street Journal, don't bet against the American consumer now. But I think to me now is that key word. So the other thing is manufacturing spending. Still lots of manufacturing spending. And this is excluding the impact of the Biden administration's IRA Act. So the Inflation Reduction Act, which is a strange name, but it's all for the energy spending and the infrastructure spending. That is going to add jobs. That is going to strengthen the economy. So this is coming. We still haven't barely seen this tick into the economy. So we also had on average wages versus CPI. You can see, so CPI being the consumer price index, the inflation measure. So as long as wages, you can see it over here, as long as wages are higher than CPI, then you technically have net income growth, so to speak. So as inflation started to come down, you could see this was not the case in 2022 at all. And that's when we had that peak inflation. So you can see it starting to come down to this place where if inflation is lower than wages, then you have net growth in wages. And so inflation still needs to fall further to support these household budgets and GDP and essentially spending. So here's a few slides I wanted to show you. So where are prices coming down? Because we're talking about inflation came down. So prices are coming down in some places, but not everywhere. So you talk about electronics. So where they are not coming down is electronics and appliances, restaurants and bars, drugstores, and some vehicle services. I brought my car in for service. I couldn't believe how much it cost. But you have other places where prices are coming down. So furniture, gas stations. So gas has come down a lot this year. So that's really, really helped with more money in our pockets, and some department stores. So you're starting to see more sales. You're starting to see prices come down. Where they're not really coming down, though, is grocery, for the most part. In some places, in some areas, yes, but in others, no. So we're still seeing a lot of inflation in food, and food is considered volatile. So food and energy are usually excluded from a core CPI measure. But I found this chart really interesting because you can see that baking soda and flour up, 15, almost 20%. That's a lot for staples, right? I mean, I don't think a potato chip is staple, but potatoes, frozen vegetables, bread, these are the things that most people eat most of the time. And meat and beef and eggs in general, and chicken, that went up crazy over the past few years. So the other reason why no recession is strong employment. So there's certain kinds of employment that were affected more than others, but we've generally had strong employment. So some of the places where we've had strong employment gains, and this is that whole inflation issue back to services, is food, drinking, restaurants and food places. Healthcare, lots and lots of employment growth in healthcare, nurses, hospitals, and motion picture, this was October, November. So this is when the strike ended. So we saw a lot of job gains through that. But really, when we talked about where inflation hit the hardest in services is also where we're seeing the most jobs come in. So you're seeing wage growth. And so that kind of fuels this little inflation cycle. Where we're seeing job losses is at admin. There's been a lot of also white collar job loss. But in general, so a lot of the mortgage industry, some of the finance industry, but a lot of admin and support services is where we've seen most of the job losses. So in general, we still have a really good unemployment rate. Anything under 4% is considered full employment. Despite everything, we are at full employment in the US. So I have a couple of quotes here from some economists about the employment rate. And this is when it says today's jobs report, this is one that just came out last week. It's boring in all the right ways. Job growth was in line with expectations and the employment rate stepped back from the edge, showing that we'll be exiting 2023 without a recession. And overall, the labor market remains strong, robust job growth, and the unemployment rate at extraordinarily low levels. As long as you have good employment, you're not really going into a recession because people have jobs, they're going to spend. If they're spending, that adds to GDP, which is economic growth. And so, in other words, no recession in 2023. This is a really cool recession indicator. Claudia Sam of the St. Louis Fed is credited with creating this. And the SAM rule says that when 3-month average jobless rate has risen 0.5 percentage point from its previous 12-month low, the US is in a recession. And you can see that it's still not, right? So the fall in unemployment last month left this recession indicator still in a no recession place. So we had this no recession in 2023 because of strong jobs, strong spending. There's an increase in onshoring manufacturing, which will continue to create jobs. There's the Inflation Reduction Act, which will continue to create jobs and stimulate other types of spending, especially around this clean energy transition. So we have, even in light of these rising interest rates, which rattled financial markets and had an outsized impact on the housing market, but not dropping prices. In fact, prices remaining high. It was this year where nobody really knew what was going on because, no, this is not true. It's not that nobody knew what was going on, but all of the predictions did not come true for, the destruction of the world as we know it due to high interest rates. So the next slide, and then they paused. So I'm talking about the Fed. So the Fed paused. So they were like, hey, we're going to go up with our interest rates, which they did. You can see it in this chart. And then they've paused. So that pause also came with a statement that the Fed is starting to look forward in 2024 to reducing the interest rate. So normally when the Fed raises rates a lot, they'll start to cut them within 12 to 18 months to avoid a recession because they raise interest rates to try to induce a recession and then they want to stop it. So it's weird because it's this knee-jerk reaction, but that's actually just how it goes. So we have this pause and this idea of a pivot. So you can see on this chart here, this pivot, what it means is they're pivoting their position and from going from hey, we're raising rates, are going to pivot and say, now we're going to start to come down. And so there's an expectation, and it's what Powell said here. He said that officially inflation is still a little bit too high. So he's leaving the door open. We might have to raise interest rates again. But really, they are looking at, they're really looking at jobs now. And so what you're seeing here with this forecast, again, is markets and economists and analysts are saying we're actually expecting the Fed fund rates to come down. So in other words, they're going to lower the cost of borrowing, and that is that's a stimulus. So that should, get everybody out of their seats and say, okay, hey, it costs less to borrow to do the things that I want to do, so I'm going to borrow again. And then we keep going. So this comes because we have these inflation expectations where we see the expectation is that inflation comes down because prices come down. Hence, the Fed doesn't need to continue to raise rates. So the Fed mandates, I kind of mentioned this, but it has two mandates, inflation and unemployment. So for 2 years, it seemed like they only cared about inflation, which is, true. But what Powell is saying is that you're getting now back to the point where both mandates are important. So this was a statement he made basically saying we're watching the unemployment rate because we know that we have tightened monetary tightening. So when they basically tighten those purse strings, no more free money, rising interest rates. So now they're looking ahead and saying this is probably going to start hitting. So we also have enough room because we've raised to 5% that we can lower if we start to see problems with employment. So we start to see employers having lower margins, lower sales, whatever you want to call it. And then they start to lay people off. And if those people get laid off, they're not spending. You can see where this is going. So now they're saying, okay, we've done our job and we're still looking at inflation, but now we're going to look a little harder and make sure that we don't get into a recession. And that's how they would achieve this unicorn of a thing called a soft landing. And it looks like they've achieved it. And if they have, credit where credit is due, it's an amazing feat. If in fact that's what happens. So I've talked about this a lot during the presentation, but here's the slide. So housing is where we're going to see a lot of inflation come down. And it's because there's a 12 to 18 month lag on interest rates in housing. So shelter CPI, so the shelter component of inflation, has been moving down for 8 consecutive months. It peaked in March, but shelter makes up 35% of the CPI. So if we actually start to see lower mortgage and lower rent, we start to see meaningful change to inflation. So this is one of the stickiest parts of inflation because it takes so long for those interest rates to really have an impact. We haven't seen, despite record home prices, the headline says housing is about to drag inflation down. That would be good. A lot of people would like to buy a home. That's not a bad thing. So this is all something that we're looking at now. So when the Fed pauses, we also see that markets adjust. So I didn't put a slide in here about treasuries, but that's what a lot of financial instruments are priced on, is the treasury rate. And the treasury rate moves in response to what the market expects. So here's another thing that happened when the Fed paused. We have seen a massive market rally, especially in the past few months. So all of the major indices, Dow, S&P, NASDAQ, they've all closed at near all-time highs. So again, the markets are a forward-looking mechanism, and they like risk. They like when there's a strong economy. They like when they think that they can make money. So the markets are pricing in lower rates, and they're telling the Fed, we want you to lower rates because we want to keep going. So we've really seen a remarkable shift in the stock markets this year. Mortgage rates. So here's where the treasuries come in. So the Fed has not lowered its rates here, but mortgage rates came down because mortgage rates are based on treasuries. And so treasuries have come down. So that's a forward-looking mechanism. So we're starting to see mortgage rates come down. They had hit almost 8% in the fall. And so they've started to come down. Markets have started to go up. So this is going to be one of those factors in looking forward that is something to look for in 2024. So in 2024, the best way I can think of doing it is plan ahead and with everything, but with a grain of salt. Because everything we just talked about, there's been a real market shift in the past 6 weeks in all of this. If I'd given this presentation 2 months ago, it wouldn't have looked like this, because we still had high inflation. The Fed wasn't really they weren't really saying, yeah, we're definitely going to pause. And they certainly didn't say they were going to lower interest rates, but they do now. So things are starting to move, but you always want to look at things over a period of time. And I also say with a grain of salt, specifically with this next slide. So Fed officials see core inflation falling to 3.2, 2.4, 2.2. Take that with a massive grain of salt, because nobody really knows what's going to happen. Nobody knows. So if this happens, fabulous. Like if inflation goes in line, great. We're going to see a strong 2024, 2025. And, this recession will get bumped to later because there will be a recession. Like market cycles, economic cycles don't go away. It'll happen. It's just not going to happen when people thought. But if inflation doesn't get in line with Fed targets, interest rates will remain high, or they will raise them again, because they will. They've told everybody, if we have to, we will, and they have. So it'll add more pressure to borrowing. It'll have an impact on spending, investment, and employment. And if it hits employment, that's when we're going to see those recession signals, and then that is when that's going to happen. So take it with a grain of salt. We have to see inflation continue to move down. But if we see employment start to crash for some reason, that's when we're going to start getting real recession signals. So what to watch in 2024? Inflation stabilizing, interest rates declining, housing market movement. So when we see those mortgage rates start to come down, and maybe more homes come on the market because people are like ready to move, then we'll actually start to see some more movement in the housing market. No expectation of any kind of price crash. So if anybody was waiting for that, you're going to be waiting for a while. That's not happening. And so I have no recession ? Unlikely, very unlikely. But again, nobody really knows. But right now the data is very strong. So another thing to watch, rising consumer debt levels. Watch your own. Definitely watch your own. Interest rates are still high. So there's some things that we'll talk about in a minute here on like what you can do about it. Employment numbers, that's one to watch in terms of recession and what the Fed is going to do. Market and investment activity. If we have this stabilizing and declining inflation, and the Fed really does lower interest rates towards the back half of next year. So that's the consensus expectation, is summer for sure, that they'll start to lower interest rates. We're going to see a lot more investment activity, a lot more market activity. So people have been waiting for this. So markets are waiting for this. 2024 is also an election year. So election year can bring a lot of volatility. So that is something to watch. So watch the difference between, election year volatility and an actual macro data. But there's expected to be a lot of volatility, a lot of promises. Pay attention to what, candidates are saying that they're going to promise and deliver. This is something to watch. And then the other thing to watch in 2024 is taxes. So here's what I mean. And Jennifer, you've talked about this, and I'll let you jump in here, and because I know you want to talk about this. Two things about this. The interest expense on U.S. public debt. When I talked about where else do interest rates hit, they hit the government because they issue bonds to pay for whatever they're doing. Who knows what they're doing? They're spending a bunch of money. Right now, interest on outstanding public debt is about to be the single largest line item on the government balance sheet. Okay, so high interest rates affect the government too. So where are they going to go get that money? They're coming after us. They're coming after more taxes. So this is something to know, because the U.S. actually has the lowest tax rate amongst Western large economies. Like Europe has way higher tax rates than we do. So that is something to watch. We'll see what the politicians say as they promise coming into office. But we also have Trump era tax cuts ending, I think, in 2025, right, Jennifer?
Yeah. So we've been in the lowest tax rate in the United States for decades. I mean, even in comparison with the 70s and the 40s, we've had very, very, very low taxes in the United States compared to Europe, yes, but even compared to the United States for 40, 50 years. So this is really significant, because right now the United States spends 98 cents of every dollar it collects in taxes on interest on its own debt. And if you have a brain, you realize that's completely unsustainable. And it's the dirtiest secret of the US economy. I could go on, but if people are being told that their 401k is a great place to put all their money because they'll be at a lower tax rate later when they retire, I call BS. There's no way we're going to be at lower tax rates when we retire. We're all going to be at higher tax rates. Those of us living in this lifetime and beyond are going to start seeing, no matter what the politicians want to promise, a rise in United States taxes. Mark my words. I said it here today, and it has nothing to do with Democrat or Republic. It has to do with what's sustainable, what's humanly possible. And plus, we just passed all this aid to get through COVID. We're funding wars. The money's got to come from somewhere. So yes, in January 1st, 2026, anyway, a huge change on estate tax exemptions is happening. And that is taking it from where you used to be able to pass on 22, which adjusted for inflation became $24 million tax-free to your heirs. And that was something that was actually started close to 20 years ago. But it was always scheduled to sunset January 1st, 2026 and come down by half. So it's probably going to come down just as scheduled to adjust for about 14 million now that you can pass along tax-free to your heirs, because they've got to start collecting some kind of tax. And of course, they'll come over to larger estates. Luckily, there's things that very, very wealthy people can do, especially with life insurance and estate planning, to help navigate through taxation on legacy. But yeah, so taxes, you nailed it, Pia. They're going to go up no matter what.
Yeah. So this is one to watch in 2024. So tax planning it's going to be a big theme. So for planning, this is our last slide here before we wrap up. So with everything that that we've covered, planning is going to be really important. So a few things. One, stay aware of your debt and your credit and your spending. Budgeting serves a purpose in just helping us understand what things should cost and then what they actually cost. Everything that I had a budget for at the beginning of the year is way out of budget just because things cost more. So that it's just an important measure. So basically watch your spending. The trick to credit is try to use these 0% financing whenever possible. There's so many of them. There's a ton of it. So 0% financing whenever you can, as a business owner, with more certainty around interest rate expectations, or as maybe as a homeowner or aspiring homeowner, if you are, it's going to be a little easier to plan because there's more stability, because we, generally speaking, now we know where interest rates are going. So that's a one big one. The second one, planning, stick to your investment plan. And think long term with your investment plan. Don't try to time the markets. Don't get caught up, because if you got caught up in the past 3 months with the rising stock market, there's the ups and downs. We had a slide of a few episodes ago where we could see the emotional wave, and it goes with market waves, same thing. So don't get caught up, stick to your plan, because markets are emotional. And so this is really important. Don't try to time the markets. And third, interest rate declines mean that cash account returns will also begin to decline. So I've been loving my 5% cash account. I just like put my emergency money and I can take it out whenever I want, 5%. When the Fed reduces rates, those rates are coming down. So if you have been, outside of your emergency fund or whatever you're saving cash for, if you've just been sitting it out thinking I love my 4 or 5%, just know that that is going away. It's not going to be that high. And then it's going to start to come closer to inflation. So then you have to look at your real rate of return. So consider if you have a lot of extra idle money, and that's been your strategy for the past year and a half, great. Like I've loved it for my cash. But if you have a lot of extra money, consider other strategies. Consider the indexed universal life policies that Jennifer knows so well. And this is long-term, right? Like think about where else can I put my cash? You can look at bonds now. Bonds are actually really competitive with stocks. So you can buy bonds, or DCA, that's dollar cost averaging into index funds. So you could slowly start to get back into what's expected to be a rising market, generally speaking, for the next several years. So diversification is always a good strategy. And now is a good time to talk to a financial professional, your advisor, about, hey, I've been sitting on all this cash, and I understand that rates are going to start coming down on my cash account. What else can I do? So a few things, always important, speak to your financial professional. And that's it. I mean, as we like to say in WOW, it's time to shift out of working for my money and moving into my money works for me. It's complex. It's not impossible to understand. That's what we're here for. That's why WOW exists. We exist to have a forum and a community, open dialogue, education about these things. And just thank you so much for being with us. And I'm gonna let Jennifer take us home.